So I just want to show a couple of short clips here from our members only live stream yesterday, because I think there's a pretty good lesson in here about not allowing a bad situation to get even worse on the following days. Now, if you're watching this now, you're probably fully aware of what happened last week. But just for future reference, we had the third largest VIX index spike in the last 30 years on Wednesday, and the VXX was up 17.7% in a single day because of it. The issue that I would imagine almost everybody had was there was really no warning ahead of time. All the volatility metrics the day before were looking just fine. So it's just one of those days where you wake up and you get kicked in the gut out of nowhere. But what these two clips are talking about is, after taking one of those unexpected losses, the importance of not making things worse. VXX went up 17% on Wednesday, but went down 4% on Thursday. Should we have delayed exiting the VXX put position by 1 day? No, absolutely not. I know exactly what you're getting at, but again, I don't exit stuff unless there's a screaming reason to exit something. I didn't want to either. In fact, if you were to ask me, gun to my head, Wednesday afternoon, do I think it's going to bounce Thursday? I probably would have said yes. I probably would have said, here's what we're going to see. The market's going to recover a little bit of what it lost on Wednesday. Volatility is going to depress quite a bit of what it lost Wednesday. And then Friday is going to be the real tell. So if I traded based on what I said, we would have been kind of right. I mean, it went down 3 or 4%. It wasn't that big of a deal. And then, of course, Friday it got crushed again. So thankfully, we moved to safety. But if I hang in one more day, that's totally random. So let me give you an example. Let's go back to the largest VIX spikes in history. I'm going to take you back in time. Of course, I was trading during this, but where is my 2015? There's August 21st, 2015. Devastating hit that day. The VIX index was up 46% that day. It was one of the larger, market crashes / volatility spikes in recent times. It was certainly on the list, and the VXX was right there crashing as well. You can see some of these are, 90, 91, 2007. That was significant. That 2015, August 21st. So do you exit or do you wait a day? What you're asking me now is, well, I don't want to exit and take my loss. I want to wait a day. Well, what happens? This was Friday. Well, what happened is on Monday, it was up another 45%, the VIX. Another devastating loss, just crushing, devastating loss. Now, I can tell you, because I was there, and I've watched all of these subscription services come and go, and I think there's 3 left since I've been watching these things surface. It's almost unheard of to have something that lasts several years. And I'm not picking on you and your question. It's a good question. But this is why. This is why nobody survives. That thought that you just had in your head, while I can understand why you had that thought, this is what causes people to lose all their money. If you hang in on the, quantifiably wrong position, to go short vol into Thursday was very aggressive. Only one of our strategies survived that spike on Wednesday. So it is quantifiably the wrong position to go into Thursday, loaded with aggressive positions. My aggressive vol strategy was, less than 1% away from moving to safety as well. But we exited almost everything. If you go with this attitude, you're going to blow up. You're going to get into one of those positions where sometimes you're right. Sometimes the very next day it recovers and you feel like a hero. You think, that was amazing. I got hit hard the day before, but I recovered most of it the next day and it's fine. You're going to have periods where you're just dead wrong. And as I've always tried to tell people, losses are more costly than gains are beneficial. Markets can go down a lot faster than they can go up. Volatility can spike a lot faster than it can depress. And you're getting into a position where you are dangerously close to a blow up. And no, absolutely not. My style is, I'm 45 years old. I'm not risking my 70-year-old capital as a 45-year-old risk taker. It just doesn't make any sense for me to do that. I'm going to take my 5% loss. I'm going to hate myself for a week, and then I'm going to get right back in there and try to whittle away that drawdown. And hopefully in a couple of months, I've recovered from it. What I'm not going to do is roll the dice as a 45-year-old that might cost that 70-year-old $1 million. Because remember, capital grows over time, and 5 to 10 years of compounding, even a low rate of return, is extremely significant. If I take a 20-30% drawdown this year, that guy 20 years from now has $1 million less money in his pocket. So I know that sounds extreme. I'm making this outlandish claim. It really works out that way. That's how the math works out. So no, when my signals say safety, it is for a very good reason why we go to safety. And I have learned that there is nothing worse than taking the wrong trade. Like Wednesday, how can I say this without sounding like it's an excuse? Because we lost money Wednesday. But that was the right trade to be in. You have to understand that the more often you do the right thing and the less often you do the wrong thing, in the long run, it will work out for you. It really will. The law of large numbers will take over and it will work in your favor. I was in the absolute correct positions on Wednesday and I got kicked in the gut hard, but I did the right thing. And then I exited to safety heading into Thursday. And that was the right thing to do. And I think we're up a little bit on Thursday, but the safety positions bled as well. Fortunately, the VPU recovered a little bit as well, but that was the right position. I can't fault myself for doing the right thing and losing money. I just can't. What I can't forgive is if I make a mistake and it turns out to cost me. Trust me, that is the worst feeling in the world. When you know you're doing something wrong and you think it's going to work out anyway, and then it doesn't. The only thing you can do is look back and say, well, I was a complete idiot and I totally deserved that. None of us deserved the drawdown we're in right now. We did the right thing. But if you do the right thing long enough for a number of years, not this year or this week, do the right thing for 30 years. And I promise you're going to love where your portfolio gets to. So please, I get it. Mentally, I get it. Nobody likes to take their licks and go to cash. Nobody likes doing that. But try to understand that it is for the greater good. Not trying to make excuses, but it is for the portfolio's greater good. You have to be able to accept losses and drawdowns. If you can't suffer a drawdown, you can't trade. You just have to pack it in and go buy 30-year bonds. That's all you can do. You have to risk money and do the right thing. Rinse, repeat for 30 years. That's it. Daniel, again, the compliment train on a bad week. Thank you. Undeserved, but thank you. We're still trying to figure out how we're going to claw our way out of this. So that's nice. Yeah, tactical trading is obviously the only way that I would ever invest my own money. Like I said, I don't do anything to impress people. I do it because it works for me and my money. And as selfish as this sounds, everything I do is for me. It's my portfolio. I have to make sure that I'm doing the best job I can for my own money. And if I do that, then hundreds of other people can benefit as well. But it's completely self-serving to me. And tactical investing is, in my opinion, the only way to do it. There's no other way to manage risk other than being ready to take several small losses to avoid the big ones. You have to be able to do that. If you're not an investor who can sustain a 5% drawdown or even a 10 or 15, then what do? You just buy the S&P and sit there, I guess. I don't know what you would do. So I'm a person who has to be tactical and willing to take several small losses in order to avoid the big hits. And there's plenty of times when we'll do well, right? That's a function of the market. There are plenty of times when we're going to participate in something great. And for several months, we're just going to be, the performance is awesome. The real key is being able to exit on Wednesday. That is not easy. There are very few people who have the emotions to be able to do that. They'll hang in there. They'll say, I'm going to see what happens tomorrow. And then Thursday, maybe it recovers, but maybe it goes down. Well, let's see Friday. Well, now I'm down 10%. Now I can't sell. It's certainly going to bounce. Well, then it goes down 15. Well, now you can't sell. I'm not going to realize my 15% loss. I'm just going to ride this out. And then it's 25. Then it's 34, like in COVID. Then it's 56, like in the financial crisis. Then it's 86, like the Great Depression. You have to be willing to take that hit. in order to avoid the big ones. You have to. And that's what tactical investing teaches us, is that it's mechanical, it's systematic. I exited, not because I wanted to, because the system told me it's too risky not to. That's why I exited. And I realized my gains and I took my losses and I ate a whole Costco apple pie because of it, but we will live to fight another day. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.